to assist you. And now, without any further delay, let's turn today's event, the Corporate Bonds, The Price is Right, brought to you by TABB Group and Interactive Data, over to your first presenter, Bill Gartland, Senior Director in the Evaluated Pricing Team for Interactive Data. Bill, you have the floor.
All right. Thanks, Phil. Actually, I'm going to introduce Anthony Perrotta, who is the head of fixed income research at TABB. Anthony's going to go through some slides that talk about what the background behind his recent piece on corporate bonds that was published a couple of weeks back. And then I'll follow up with some of the work that we've been doing here at Interactive Data to try to demonstrate how our content can help address some of the problems and situations that Anthony described. So Anthony, would you like to give us your thoughts?
Great, Bill. Thank you for that, and it's great to be here with you to talk about our research and continuously evaluated pricing models as they develop in the marketplace. The basis of our research really stems from the structural changes that are going on in the corporate bond market over the last 2 years in particular. As we can see on the slides that's up on the screen now, the credit markets have been growing unabated over the last couple of years. We're now just shy of $8 trillion outstanding in the investment grade and high yield corporate bond market. It accounts for about 20% of the traditional U.S. bond market outstanding. Low nominal interest rates and an accommodative Fed policy have really spurred the issuance of debt in the marketplace, especially as people have been reaching for yield, turning to the corporate bond markets. We had almost 1.5 trillion in issuance last year, which was a record. We've laid that out in some of the graphs that you can see on your screen at the moment. The corporate bond market, as many know, is not a homogeneous marketplace. It consists of over 42,000 unique issues, and that creates a very difficult environment to smoothly do search and discovery and accurately price issues. As we move forward here, what we see is with respect to customer activity since the height of the financial crisis, we see that investor activity has grown tremendously across all trace market segments. But perhaps where we've seen most of that growth is in the expansion of what I would call smaller trade sizes. Given the low level of nominal yields and the way that retail investors react in such an environment, we know that retail investor business has been somewhat stagnant over the last couple of years. So the increase in smaller trade sizes, we can speculate without any real hard data to make an accurate assessment, is coming from the institutional constituency. And as the institutions move towards smaller trade sizes to get their risk needs fulfilled, we believe it's partly because of the lack of liquidity that exists across the market holistically, and they're breaking up trade sizes to get what they need accomplished. There are several catalysts, which are probably familiar to most of those who are on the call today, and market participants that are driving market structure change. But more importantly, these catalysts are also driving business model change, both within the dealing community and within the investment community as well. So the three main catalysts that we focus on at TABB are Dodd-Frank Title VII, and specifically with respect to the cash markets, within that is the Volcker Rule, affecting the manner in which dealers can be involved in market-making businesses and proprietary trading businesses. The second is probably the one that's impacting the market, in my estimation, the most, and that is the Basel III Accords. There's a little typo on there, I apologize. And the capital guidelines and the liquidity coverage ratio and supplemental ratios here in the United States for the U.S. corporate bond market. And then the third thing is the increased emphasis on shareholder value within the banking sector. And really what that boils down to is a focus on return on capital demands for shareholders. So what's really important in the equation overall is that dealers are adapting to a new environment, a new regulatory environment, and a new market structure environment. And what they've done is they've tweaked their business models away from a top-line revenue growth and market share model to a return on capital model, as we already mentioned. As a consequence, many dealers are issuing principal risk transactions and executing more riskless principal trades, which in the fixed income market have been incorrectly named agency trades. We don't have a pure agency model in the fixed income marketplace as we do in the equity markets and others, partly because liquidity providers still extract profitability from transactions via the bid-offer spread and not on pure pre-announced commission schedules as we have in other markets. But really, what's driving the structural change in the marketplace is a withdrawal of two forms of liquidity that I tend to focus on. The first is immediacy, which is immediate risk transfer. And then the second is more a notion of what we term obligated liquidity, where dealers have tremendous relationships with a buy-side counterparty, and irrespective of their own desires in terms of view on a credit or a particular issue or whatnot, they're willing to provide liquidity at some price and provide their balance sheet for that client to use for risk transfer. The withdrawal of both of these forms of liquidity has a significantly negative impact on the efficiency of electronic models and trading protocols overall, in particular the one that's primarily used in the marketplace, which is both the voice and electronic RFQ. The request for quote is basically mired predominantly in the principal risk model, and I think over time that traditional source of trading mechanism in the marketplace is going to slightly deteriorate as we move forward and the market changes somewhat. So we just talked about the predominant model. Let's call that the status quo for the time being. So the status quo of providing balance sheet to your customers and being able to respond to their specific needs in terms of inquiry for risk transfer may no longer suffice. We've seen the chart on the right, we've seen the New York Fed numbers, the primary dealer inventory numbers, which have fallen off precipitously to the tune of 76% down since just before the crisis. A lot of those numbers create a false narrative in the marketplace because most of the run-up of that inventory has a lot to do with away from the primary credit markets, the investment grade and high grade markets, and have a lot to do with the value and issuance of mortgage-backed securities. But we're still at pretty much significant lows in terms of dealer inventory. There's a bunch of different reasons why that is, and certainly some of them make a lot of sense. There's not a particularly good reason for dealers to be long inventory given the tightness of spreads and the low nominal yields. There's a lot of downside risk for them to do so. But that being said, in the status quo model, the principal-based model, inventory is used obviously to attract buy-side investors and to promote more transactions. So as those numbers continue to fall, potentially the transaction numbers will fall as well, and that impacts the overall marketplace. What's really interesting about the whole conversation with respect to traditional liquidity provision in the marketplace is the notion that balance sheet capacity amongst the top 10 dealers has not really changed that much since the pre-crisis era. We estimated at TABB, having spoken to most of the large dealers, that their balance sheet capacity for secondary market-making transactions in investment-grade and high-yield corporates was approximately $120 billion in 2007. That has fallen to about just under $100 billion today, so a decline of roughly 20%. That's not a significant change relative to the numbers we're seeing with respect to the reduction in inventories. But what's really, I think, impacted the marketplace more than anything else is that that's a negative direction, and then when you combine that with the upward sloping direction of the size of the market and the concentration of assets within fewer larger buy-side accounts, in particular the traditional asset managers that we have in the marketplace managing more assets on the behalf of other investors, that creates what I call the ratio of liquidity provision to outstanding assets. And that's really gets down to the impact of dealer liquidity today, and we're seeing a significant decline in that. So if we look across the three bars on the graphic that's up on the screen now, we see that in 2004, generally considered the height of liquidity in the corporate bond market, we see that top 10 dealer balance sheet as a percentage of outstanding assets was at about just over 2%, 2.1%. That actually increased in the run-up to the financial crisis to about 2.25%. And in 2014, we've declined by almost a factor of 100%, down to 1.25%. So dealers just don't have the ability to provide liquidity in the same realm that they did prior to the crisis, and I think overall that's hampering risk transfer across the board. More importantly, I think what's happening is that because liquidity is declining specifically in a large portion of the corporate bond market that is not deemed on the run or highly popular issues such as the Verizon issue or some of the other larger issues that exist in the marketplace, I think increasingly that's causing a herd mentality into a smaller segmentation of the corporate bond market, and investors are going where they can find liquidity generally to do transactions on a regular basis. One of the other things we took a look at when we did our analysis, both in our corporate bond conundrum report and then again in the data report, is the empirical data that's available to market participants today actually gives us the false narrative that there's a lot of liquidity in the marketplace. So what we've done is we've compared both median credit bid-ask spreads and median credit bid-ask spreads by segment. And if you look at either iBox spreads or the market access bid-ask spread index, you'll see that spreads have come down significantly, tightened significantly from the financial crisis. And in fact, they're back at levels in the years leading up to the financial crisis. Now, why do I say this is a false narrative? Well, for me, it represents a false narrative because we do see that there is a significantly larger amount of riskless principal business that's getting executed. And in the graphic on the bottom of the slide here, we believe that the quoted market, which exists in the principal-based risk structure, is deteriorating, and that dealer quotes in general no longer indicate where things will trade, but indicate where things may trade. Now, that's not across the board for every issue, but for a large portion of the marketplace, again, especially in off-the-run issues, quotes are given as a way to attract business, and essentially what dealers are trying to accomplish is they'd be willing to provide immediacy for a subset of the amount of notional that an investor may want to move off their balance sheets, transfer risk, in the attempt to attract an order on the larger trade size. So let's use a practical example. Let's say you're an institutional investor and you have $10 million of an off-the-run bond that you want to trade. A dealer might quote you, let's say 85.80 over the 10-year for a sociable size like $2 million in the hopes of getting an order on the remaining $8 million balance. Essentially what happens is the dealer goes through their distribution process, contacting other investors to see where they might have interest in the security. If it's an on-the-run security, the trade may occur in the context of the quoted market or just outside of it. But more often than not, for the liquid securities or off-the-run securities, there's a liquidity premium that's associated with the transaction. So another traditional asset manager will give the dealer a bid that might be at, let's say, 90 over the 10-year, 5 basis points back. When that transaction actually gets done, assuming the seller just wants liquidity and is willing to hit that bid, the transaction will trade at a very tight bid offer, like 1 or maybe at a maximum 2 basis points. So the transaction will show up in the post-trade trace data as a 91.90 transaction with a 1 basis point bid-ask. That creates the false narrative that the bid-ask spread in a security is particularly tight. So overall, we don't believe that the credit markets are moving significantly to an order-based marketplace similar to the one that we have either on exchanges for futures contracts or obviously in the equity markets where we have a limit order book structure and continuous pricing in the marketplace for risk. But what we are seeing is a subtle move to order-driven markets. As the principle-based model of risk transfer is under siege by these catalysts and is deteriorating somewhat, and dealers are becoming more prescriptive with how they use balance sheet and retracing the amount of immediacy they provide. Again, we talked about how the value of dealer quotes, the traditional value of dealer quotes, is deteriorating, and dealers are relying heavily on these quotes to attract flow, but once they get that flow, if the size is outside the parameter of where they feel comfortable moving that risk onto their balance sheet, they're increasingly taking orders. So looking at the graphic, again, not a lot of hard data to look at, so this is more data that we went around the marketplace and talked to dealers about, the breakdown of their business, and also talked to large traditional asset managers about the breakdown of their business in terms of how much was getting done on the wire versus through an order-driven model. And what we see is in that 2007 for investment-grade marketplace, we were right around 10% of transactions had some kind of order associated with them, and about 30% of the high-yield market had orders associated with before there was risk transfer. And that's because dealers, for the most part, were willing to use their balance sheet and use their capacity in order to provide risk transfer for their clients. In 2014, the stories we got have those numbers moving much higher. In the investment-grade market, we're somewhere just north of 30% of trades that are $2 million in notional and higher get executed only after a dealer has been given an order, and then it occurs at some later point in the day or the week or the month even, depending on the issue. And for the high-yield market, we're north of 60%, somewhere between 60 or 70%. So essentially, we think there's a development for a new paradigm. There's certainly changes in micro-market structure. The balance of power has definitely shifted. Dealers, because they have new constraints that they're operating in, the fact that the asset-owning community has gotten significantly larger and maybe even concentrated, the buy side is becoming more relevant in the equation. The market is gravitating towards a hybrid approach that we just talked about. So the current zone we're in is this hybrid between principal and riskless principal transactions. Perhaps the target zone will incorporate down the road some sort of agency model to it. We're not quite there yet. But there's no doubt that market participants are contemplating a new market structure. Technology, connectivity, and electronic trading is all playing a significant role in the development of this new paradigm. But more importantly, there's a driving force, and I think Bill will talk about it in a little while behind this, which is data. At the moment, there's no consolidated mechanism for pre-trade transparency that's available in the fixed income credit markets. We rely on dealer quotes for that pre-trade transparency. It's very different than the equity markets, where order-driven risk that's put into limit order books basically becomes the pre-trade transparency. So in the absence of that, as asset owners potentially make the move from pure liquidity takers to price makers, where maybe they're managing their own risk in the marketplace, where they're comfortable entering and exiting risk positions, they're going to increasingly need tools to manage that process. And one of the tools, which is becoming a proxy for price-based orders or spread-based orders that exist in the marketplace that are live and executable, is a data model which gets you as close to a valuation of what the asset's worth as possible, and will potentially move us away from a credit market whereby we're trading not on asset value but on liquidity value. And I think that's where we are now. So I think with that, I think it's a good segue, Bill, for you to talk about the data model and the tools that are developing in the marketplace.
All right. Thanks, Anthony. So let me get started by thanking Anthony for his time. This was the paper he wrote. I think we read with great interest. There's plenty of we've built a new pricing approach here at Interactive Data over the last several years, which we launched back in the fall last year, where our end-of-day prices are now being we've revved up the engine, and we can now publish prices through the evaluation process throughout the day. We're live in the U.S. We went live at the beginning of the year in Europe, and we have our roadmap out for Asia-Pac for mid-year. So when we last talked on the last webinar, I presented this slide that showed the use cases that we were working towards. And I've highlighted a few here, which I have a few slides to walk through to see where we've gotten to and what client reactions have been. They address many of the challenges that Anthony described earlier, the drop in average trade size, the shift in focus of the buy side as more of a price maker, the need for different pricing sources to fuel electronic trading. So we'll talk about a couple of them, the highlighted ones, the reference point for price discovery. There's many new, there's about 18 new ECNs, alternative trading systems that are launching or about to launch, along with the incumbent platforms, all of whom are trying to find ways to validate the markets that they're posting. So we've seen great interest from our clients on that front. We've got a few marquee names, I believe, in the offering that will be integrating our pricing into their platforms to show as a reference price, to give one more point of view about where the value lies in the market. We do rely on some of the same sources that many of you out there are receiving today. It's just that it's our day job to sort through that data and render it into a streaming set of prices that help everybody understand where the value lies in the market. We've seen much interest from the ETF community. There's some interesting slides I think you'll find when we talk about best decks and performance attribution, along with some potential compliance, both pre-trade and post-trade. And we've actually beginning to get quite a fair bit of interest from being able to use our intraday updates as a way to streamline some of the frenzied price validation that occurs at many of the mutual funds when they have to cite their NAVs every night. So let's start by looking a little bit at the price discovery side. This chart shows the number of days that a bond will trade as a proportion of the number of days in the month where they were trading. I looked at this for the last 3 months. Haven't done the numbers for February yet, but you can see a fair bit of consistency that there's an enormous number of bonds that trade just a handful of times a day. In fact, a third or more, nearly 40% of the bonds are only trading on half of the available trading days. And this is of the subset of bonds that trade at all. There's about 40,000 bonds that are listed as trace eligible. And as you can see here, only between 14 and 16,000 of those bonds, 15,000 of those bonds actually traded in each of the 3 months leading into the end of the year and to the turn of the year. There's a little bit of a bump at the end of the bonds that actually traded every day. There's a little bit of a holiday effect going on there with, not a lot of activity on the day after Thanksgiving in November or Boxing Day and Christmas Eve in the U.S., and whereas it sort of returns to normal pretty much in the new year. We feel that that the concentration of trading into that small number of bonds that trade extremely frequently, leads to competition. It's hard for the buy side to actually uncover trading opportunities in size, partly because there's so many people poring over the same set of bonds. And so by having pricing, a streaming set of prices that is available, on a continuous basis, it'll let you, come back through, down a bit back into that, other part of the curve. Bonds that trade relatively frequently you can become more confident because there's a set of value out there that can lead you to see where the value has been and how it's evolved over time.
Hey, Bill.
Yes.
One of the things I wanted to add, because you're on this point, is we didn't have this slide in the presentation, but it's certainly something that we're aware of. We found that in the second half of 2014, roughly 60+% of the notional volume that traded in the corporate bond market occurred in 8% of the the QSIPs that traded over that period. If you add in the fact that there were a lot of QSIPs that didn't trade even once over the second half of 2014, the actual percentage of total QSIPs that command 60+% of the notional volume is actually fractionally smaller.
Right. No, that's absolutely true. We've seen the same thing. I think my chart was trying to show that same impact. I think the next step we'd like to talk about, we've started to look at the continuous evaluations. We began by looking at the symbol level, the single bond level. Now we're starting to take views that go a little bit higher in the stack. And in one place that we're working is, with our clients that we currently are servicing to provide the intra-day INAVs on the ETF front. So, this example shows for one of the funds over a period of a week in January, a comparison of how INAVs are currently calculated, which is represented in the blue line, versus how the shares have actually traded, which is the green line. And then the red line is an INAV calculated from our continuous evaluations. Now, the difference between the blue and the red is that the underlying asset prices have historically, for INAVs, been calculated using a static spread model. So you take the spread at the end of the prior day, and you use that as a spread over a benchmark, and have the INAV calculated on something that only accounts for the interest rate moves over the following day. We are now able to account for credit spread movements through our continuous evaluated process. We have our evaluators making those adjustments when the market expresses a change in its opinion about the credit spread. And as you can tell from these charts, the degree of correlation between our new model, the red line and the share prices, and the old model, the blue line and the share prices, our new model is considerably more correlated to the share price. You're getting a much more accurate view of the underlying asset value, a much tighter view of how what is the true premium or discount of the fund at any moment in time. And we've been talking to many of the fund managers today about going through their pricing committees and getting them comfortable with making a switch over to use the new CEP, which will be more than just a regulatory check-a-box. It's actually a relevant, valuable piece of market information that we think the sponsors that we've spoken with have been very positive about. Helps them manage the bid-offer spreads that their market makers are making in their funds. There's a few other charts here that are interesting. So, one might be, one example here coming up is another fund. Again, we've looked at here the red line is the trade line, and the green line is the continuous INAV. But you're able to spot, when has this fund, begun to trade at a significant discount. Now, if you're an authorized participant in the ETF community, this might be the signal for you to actually create shares, right? Redeem shares. It's easy for you to there's a big arbitrage opportunity. So you buy shares in the market, present them to the fund, get the bonds back, and then sell the bonds at presumably a more advantageous price and pocket the difference.
Hey, Bill.
Yes, sir.
This is a really relevant part of the conversation because what we found, we just put out a report on the ETF market as well, which followed the corporate bond data report. And what we found is while fixed income ETFs, specifically in the credit space, are obviously a small part of the overall fixed income investment community model on the institutional side of the equation, traditionally a retail product, the growth rate of ETFs has outpaced the growth of the overall corporate bond market significantly, and institutions are significantly moving towards adopting the use of that product to manage alpha and manage flows. So I think this is a particularly relevant point for investors in the product as well as issuers in the product.
And it's, I'm actually in London this week, and over here it's exactly the opposite. The ETF market is 80% dominated by institutions and only 20% in retail. So it's the flip. So maybe we're going to come to an equilibrium across the ocean here, and both of us have a greater participation rate from institutions. And one last slide on the ETF idea is, here's a concept drawing that we've made, and we've talked to a few of the ETF sponsors, and shows what might be referred to as the arbitrage band. So here, instead of computing one INAV based upon the bid side of the market, we've computed the three: bid, mid, and offer. And as you can see, the shares tend to trade at the middle of the market, and which is here the light red line. And then you can find where do the share prices breach the is it the bid derived INAV or the offer derived INAV, which can tell which can tell the trader of the ETF whether or not he should be redeeming or creating shares through his relationship with the fund. Now, a lot of people, we've had a fair amount of success with folks using our Excel add-in to build these models so they can run on their desktops, and that's been a very interesting opportunity for us. In the next slide, I've labeled it compliance and best X. It really goes back to what Anthony was talking about as to the fragmentation or the downsizing of average trade sizes. That led us to have to do some work to reconsider some of our modeling techniques and some of our how we perceive the information value of different data points, particularly the ones that come through trace. Historically, smaller size trades were sort of erratic in terms of the level at which they were traded, and we would tend to underweight trades that were under, say, $1 million block size. What we found more recently is that there's a much stronger relationship between where the trades are actually occurring relative to where our continuous evaluation bid price is set up. So I'm going to walk through pretty quickly a handful of slides, and I'll spend some time on the first one to give you the context, but I think it's more impressive to see them kind of play through like in almost a motion picture style. So in this example, I've taken all of the trades that occurred against the 5-year benchmark in January of this year and created a set of bar charts. Now, the red lines represent the median difference between trade prices on trace and our contemporaneous bid side continuous evaluator price, and the green bars are the same difference but taken against the dealer buy trade. So it's dealer sell in red, dealer buy in green. The bottom of the chart, there's a table that shows the actual values that we're plotting. What it shows is that when dealers buy bonds from trade at the 5 million and up trade size, they're buying bonds at the median difference is zero, right? So on average or at the median, the trades are occurring, at the bid side of our continuous evaluator price. As you go down in trade size, we're using that same continuous eval, which is what we target to in the evaluation process, come up with a institutional round lot bid side market. So I think we achieved, this shows that we achieved our goal overall for this segment of the market. As you go down in trade size, all the way down to 100K and up, we're within pennies more or less of the bid side of the market. Then when you get to the odd lot, 100K, 25K to 100K and under, and the micro lots under 25K, there's a bit of a discounting going on, so the dealers pay a little bit less for the bonds. They tweak the seller a bit to take the small lots on because they might be a bit more difficult to move in that small size. On the dealer, when the dealers are selling bonds to the market, there's what this effectively shows you is a market-derived bid-offer spread. So we're using our spread, which we see as no difference on the median versus where the market actually trades. And then, at the largest lot size, the markup is about 16 cents, and it moves to a quarter, and it's sort of inversely related to the trade size. So as trade sizes go down, the markups go up, and for the 5-year, you get to about 3/4 of a point to 7/8 of a point in terms of markup at the smaller trade sizes. Now, if we look at it for the 10-year, we see essentially the same pattern, although there's a bit of a DV01 effect in that the bars are slightly higher, have a slightly higher value, all across the board. But what's impressive to me and to others is that now in this next slide, we have in the top left, it's the November data, then it's the December data below that, the January data that we looked at before to the upper right, and then a fourth chart, which is a particular bond, the Bank of America 420s of 24, which, to the naked eye, these all are showing the same pattern. So, I think we're finding that, we can use that the data that we see particularly for the dealer buy trades at much smaller trade sizes has just as much information value to our evaluation process as even the largest trade sizes that were traditionally the driver of many of the evals. But more importantly, this pattern persists day on day, month on month, and presumably after we've had a year or more of our evaluations being in production, we'll be able to tell you that it's year on year. Now, and we may even observe some seasonal effects. We're not quite sure what the future holds for us, but we think this is an important pattern that we hope to leverage and bring out to the market so that folks like yourselves can use it in your own best decks, compliance type tools. And we've mocked up one more example. So here I'm going to take the Bank of America bond and take the red bars and flip them into a red median line. What this chart shows is the red median line. The gold line represents the 90th percentile of the markup. And then I've scatter plotted 20 random trades just showing how they distribute across the segment. Now, there's lots of ways to interpret this chart. Some might look upon it as a best deck screener, so trades that are below the that are executed below the median level of the market context might be deemed good. Trades that are in the middle of that, if you're a compliance officer, you might want the trader or the portfolio manager to comment on why he executed it at that level. And trades that are above whatever threshold you choose might be the ones that you want to either as a compliance officer put a block in so that the trades won't go, so the prices won't even be put through to the market, or at least have a comment and maybe some supervisor approval to send those trades out. So I think those are these are the many of the front office applications that we've seen come into play. And then for the back office side, we've begun to see clients, and here's a mock-up from an Excel add-in that looks at what are the biggest movers on the market today. So if you're, this has applicability across many facets of the market, but in particular for our back office clients, they want to know, watch their portfolios and see what's moved, significantly through the course of a day, so that they can get a head start on evaluating on their own and verifying and validating the prices that they're using to set the portfolio values at the end of day, and the billions of dollars of mutual fund transactions that will result from those NAV settings. So here, you're able to see and keep track of what bonds have moved the most, and go back and importantly, through our Vantage screen, we can see not only that the market has moved, but when and why. So in this case, this bond moved up at this, sort of about 2/3 of the way through the chart because of a significantly large set of trades that went off. And this is a part of a standard protocol within the back office community to understand why and verify that there's really market data behind all of these moves. So that's what I had for today. I'd like to thank everybody. We'll now open the floor to questions, and I think we have a few questions that my colleague will ask us.
Sure. First question is for both of you. It's a question on buy-side to buy-side venues. What role can they provide as an alternate to dealer liquidity?
I'll take that one, Bill. I think at the end of the day, market participants are looking for solutions to the liquidity conundrum, and obviously alternative trading venues offer that hope to market participants. But it gets back to the data that's available to market participants and how ultimately they can arrive at the transaction point. So, excuse me, looking at buy-side to buy-side venues, in the absence of this consolidated pre-trade transparency that we've been talking about in the form of real executable orders, how are asset owners supposed to arrive at a point in which they feel comfortable transacting risk, i.e., what is the asset truly worth? In the past, dealer liquidity and dealer quotes have provided that pre-trade transparency and price discovery. The alternative venues, such as dark pools, for instance, I think dark pools represent an interesting concept in OTC fixed income, but without knowing where the midpoint or the actual execution price should be, without having any true accurate pre-trade transparency to get us to that point, and the fact that, as we get more concentrated in terms of the types of people that are owning assets and this symmetry in investment philosophies that we have out there, we could be dealing with a lopsided bid side or offered side in terms of inquiry. So it might not be the right macro environment to bring buy side to buy side together, but obviously the network effect goes a long way in connecting people and uncovering that one-off investor or maybe a small handful of investors that have an alternative view on a credit or an issue and could potentially be the opposite side of a trade.
I would agree with that. And I think there's also the point that there's a handful of protocols that are out there now that are tried and tested, but I think there's other there's plenty of bonds that get locked in. We looked at the chart before that showed how many bonds don't trade but for a few times every month, and we talked about the ones that don't trade at all. How do you get those bonds to trade anywhere, right? And and as Anthony was pointing out, how do you get people comfortable that I see a one-sided market in that somebody's offering to sell it? Is that a bona fide price? I think that prices like ours and some of our competitors have reference prices, and trying to get that information into the flow will enable, encourage, or empower the buy side to actually feel that they can commit to that kind of a trade, because they still have the same. There's an evolution process on how do they demonstrate best X in those kinds of trades when there aren't dealers involved, and that's I think we all have to try to figure out how to get over that speed bump.
Yeah, and I think, Bill, I would add also, obviously there are transparency mandates which are developing over in Europe with respect to the OTC cash markets. But here in the U.S., as we look at the corporate bond market, really at the moment, the only fixed mechanism we have in place from a regulatory perspective is the trace reporting mechanism. And the reality is it's really only a portion of the equation and can really sometimes create a false impression of what asset values are. So, for instance, a lot of people ask me, what do you mean by that, Anthony? Isn't the last trade where the asset should trade? And I would ask you, if that particular transaction had components which didn't generally indicate a broad, let's say, view in the marketplace. So, for instance, let's say I'm an investor and I just went to one particular dealer that I have a great relationship with, and that dealer just wasn't particularly high on that credit or was positioned the wrong way and offered you a liquidity bid, and you decided for reasons that are only known to you to hit it. You've now established a benchmark price in the marketplace because it's now reported back out. Or let's say you went to a handful of dealers, 6 or 10, and the 18th or 19th or 50th dealer that you didn't go to may have had a better price. He just doesn't have a relationship with that investor. What does best X actually mean? What does TCA actually mean in the OTC fixed income markets? It's somewhat ambiguous now, and it's always been very vague and ambiguous, but it's getting even more so. So I would argue that the mechanism we have in place, while providing more transparency for asset owners, actually could lead them down a false path, and that any of the tools that develop, more transparency in the pre-trade environment obviously creates a better environment for asset owners to value their assets, potentially become price makers, or for that matter, have their liquidity providers working on risk transfer for them because they'll be more educated about what their assets are worth.
Fair enough.
Thank you. Next question for Bill. What sources of inputs does interactive data use for continuous evaluated pricing?
Sure. So we're leveraging what we've historically received for our end-of-day process, but it comes from a wide range of different sources. We collect, obviously, the trace data is an important input for us, notwithstanding Anthony's caveats about where it can be misleading, although I'd say that's, I think, one of the value-added services that we're providing is we heavily curate that data and have probably studied it more than anyone else. We do collect. We have many dealers who share with us their runs. So we have our own parsing technology that give us the ability to extract data points out of that. We work with many ECNs and exchanges to receive data. We have broker feeds coming in. So on average, we're seeing somewhere globally around 10 million individual price points per day that we use to fuel our process and project out across from the liquid side of the market into less liquid and where there's into spaces where there's less information, direct information available about the individual bonds.
Thank you. That's all the questions.
That was all the questions. Well, if there are no other questions, I'd just like to thank everybody for their attendance today and for their interest in the webinar. And I'd like to thank Anthony for taking the time. There will be a short survey that gets posted at the close of the session. I would like to ask everybody to take the time to give us their feedback, and we'll hopefully make future webinars that much more targeted to your interests.